The Working Investor. Today, we're going to talk about an interesting concept. Why not put 100% of my allocation into a high yield ETF, such as YieldMax's YMAG, which I like, which is the Magnificent Seven ETF, and they returned to, and I've had 100 shares of them, and I got a 38% annualized return, which was phenomenal because I got $67.73 in dividends, and I only put up for 100 shares 2108.66, and which comes out to be a 0.32 if you divide it by 100, so it's a 3.21% return on money in 1 month. And if you multiply that by 12 for 12 months of the year, it comes out to be a 38.5% annualized return based on that payout. If that payout consistently returns that. And of course, I can always buy in cheaper right now because it went down and lost some NAV after the payout. So why not? Why am I doing all my crazy methods just to get, like this month so far, it looks like my running tally is a 28% annualized return. And I could be getting a 38% annualized return. I'm leaving money on the table. Am I crazy for not doing that? So there are several factors I wanted to get into, and we'll get into how my trading strategy evolved. And personal finance is personal, and everybody has their own personal goals. So the question, well, let's jump over here. Why not 100% YMAG? Like I can put all my assets into YMAG, maybe even use all my buying power, and with Robinhood, based on my account size, I would get a 6.55% interest. But if I'm paying 6.55% interest and I'm making 38% annualized return, I'm definitely, getting about 32%, 31% annualized return. Take off the taxes, I'm still killing it. So why not just go 100% with full, margin and everything? So there's a couple of reasons, and I'm not that thought definitely. If you heard me in other videos, it definitely tickles my mind and makes me think about it. I've seen YouTubers like YieldMax TV that does it, and I have a lot of respect. That takes a lot of spine to do that, and he goes all into AMZ, which I have a lot of respect for, because when you see somebody succeeding and they have a lot of spine, that's good. But everybody has their own strategy. So number one, there's possible NAV erosion. And also, like when I'm mostly liquid. I'm very liquid because when I do my cover calls, I'm usually on the put side, and I'm just pretty much, it's just a cash secure put. I get the cash. It's very clean. I'm out. I don't have to worry too much about the NAV erosion. Also, I like to be in control of my trades. So you don't have any control of the strikes and when the expiration dates and what methods they're going to use and what market conditions. So I like to be in control to whatever I can. Another reason is because of I like to do 0 days to expiration, 1 day to expiration trades. And even though my running return is 28% for this month, my return every single month has been sucked down because I had this 100 shares of S&P 500, which I'm finally relieved I got called away. And I understand I have to pay the long-term capital gains because I held it for over a year. But now I have the funds liquid in my account, and I can do stuff, get in and out of trades, because my style of trading a year or two ago when I acquired the 100 shares is way different now than it was then. So if there is a black swan event, right? Obviously, things can happen in 1 day and things can fall. But I would say if you're stuck in something for a while, let's say you do a monthly or 2 months out, because if you go under the YieldMax, their synthetic cover calls, which is rightfully so. They're a few months out. They have options that are a few months out based on the market conditions today. But if something changed in the interim, there's a lot of downside. You know what I mean? They could lose a lot of NAV erosion. They may not be able to give dividends if they're losing money. So I would say 1 day, 0 day to expiration. If something happens, you're out much quicker than you would be than a few months out. So I like the liquidity. I like the money in my hand. Also, this could be a double-edged sword. Like some people like to be more passive and everything, and that's part of the compelling reason why somebody would want to go for these high yield ETFs YMAX, YMAG, or the individual ETFs they have for the individual stocks, or other companies like Defiance, whatever, you fill in the blank. So like it's very hands off. You just buy the assets one time and you just don't even look at it, and you just have that dividend come in. But then you're losing out on skills if you're somebody who likes to trade and wants to build up your skills and get better and better at it, get the experience, learn how to manage risk. You won't learn that. So it depends. This could be a good or bad. It could be a pro or a con. For me, not learning how to trade is definitely a con, because I like to constantly be engaged with the market and know what's happening. I don't look at the market all day and all night. I work full time. I have a full time life, but I do check in on the market a few hours a week, throughout different days of the week. And I like to learn. I like to grow as I'm evolving over time. So that's a reason why I like to do it. It's the liquidity and it's the evolution over time. And just to go back on my other point, yes, YMAG beat me because I'm right now running 28%. But if you look, like I said, I got sucked down because of the roles I've been doing, but I'm out now. And the 0 day, 1 day to expiration options, watching people that are doing it better than me, because they say you always want to take advice of somebody that's further along than you. If you want to get financial advice, find somebody wealthier and more successful than you in a certain area. You want to go out of theoretical and you want to go into practical and find people that are where you want to be. You want to surround yourself with winners and where you want to be. If you want to don't take relationship advice with somebody who has broken relationships, especially if it's their fault. Take relationship advice from people that are together for 50, 60 years. Take health advice from people that are healthier than you, not people that are sicker than you. So you always want to take advice from the winners, of people that are where you want to be. So I've seen the average Joe investor. I've seen there's another guy called Retire on Premium. I think it's like Retire on Selling Calls and dividends. Very nice guy. These YouTubers are not like massive because they're very specific and they appeal to a certain type of trader. And these people are returning a lot more than 28%. And if I'm going into that style of trading, I would probably anticipate a similar type of return. I do try to follow some of them on their discords, and sometimes it's worth to pay money to learn from somebody, get knowledge from somebody. So how did my trading evolution strategy change? And you'll see with yourself that I hope every single year you're getting better and better at trading. You're learning about risk. You're learning about bear and bull markets. You're learning about size of your positions. You're learning about deltas and everything, underlyings, allocation. So I used to chase after, just like a rookie guy, in the rage when everything was going up after the COVID drop, everything went up. So I was going after like Mara, Workhorse, Robinhood, SoFi. I mean, some junky hype stocks. I mean, one could argue that SoFi and Robinhood are not as junky, but the point is, it's not consistent with my current investment strategy. And then I decided to pivot to the Magnificent Seven, which is like the mega cap, blue chip mega cap companies, like $1 trillion, net worth or so. And, if you look into the S&P 500, which is 34% tech, and in the tech, the highest weight is on the Magnificent Seven. So really, are you really diversified when you go to S&P 500 when the majority of the moves it makes is from the Magnificent Seven? Because look at the allocation based on weight. QQQ, so are kind of like, there's so much consistency and correlation. I went into, I have like a mix of the Magnificent Seven companies. Like I like things that are a little more in my price range, like Apple or Amazon or Google. Nvidia I did dabble with it a little bit. And then also SPY, QQQ, IWM. So if you like to do the 0 DTE, 1 day to expiration options, I find myself right now starting off the beginning of the week with the large, the QQQ, IWM, SPY seems a little too rich for me right now, and I have SPY in retirement assets where I'm just long or just buying, pretty much dollar cost average in with every paycheck. So right now I figured let me stick with QQQ IWM. I'm so weighted with the S&P 500. And I figured the beginning of the week, you can start doing 0-day, 1 day to expirations. And towards the end of the week, when you're 1 day towards before Friday, like Thursday, Wednesday, Thursday, I could kind of pivot into options in like the mega cap, like Amazon, Google, or so, Apple. And you could do like 1 day, 2 day to expiration, 0 day to expiration in those as you get to the end of the week. So I could kind of like mix and match depending on where we are in the week. And they're all pretty liquid. They have a lot of trades, a lot of volume. And I do the wheel strategy, but I'm also kind of open to the idea. I learned from another very successful YouTuber. Not as successful as a YouTuber, but successful as a trader, kind of like smaller as a YouTuber. It's called The Outlier. He says he made over $1 million doing the covered strangle on IWM, what I understand from watching a bunch of his videos. And we can get into the cover strangle in different video. There are many videos out there that could teach you more about the cover strangle, which is kind of like a little bit of a wrinkle with the wheel strategy, where you can kind of step your way into to a position. So kind of like the wheel cover strangle kind of technique. I do some triple leverage products. I do the Russell 2000, aka ticker symbol TNA, and I do some TQQQs. I've noticed I like to start them off like after the weekend, like in the middle of the week usually, and then or beginning of the week, and then just and then for like about a 1% return. And I learned that from the guy who does retire on selling cover calls and dividends. That's the name of his channel. Not retire on dividend, retire on selling cover calls and dividends. And he also makes about 1%. The people who I follow are making about 1% or just under 1% return per week, which is about a 52% annualized return. Again, past performance is not indicative of future gains, but this is something that I'm looking for. So arguably the number of 38%, which I'm not beating, that argument we'll see, I will prove to myself and see if it actually works to fruition. In that said, I do see some benefits with the relaxation of just having YMAG. I know there's two schools of thought. There's one school of thought like the Oracle or YieldMax TV, you just go in all in, like, with everything you've got in one like chunk investing, and then there's like dollar cost average investing. But I see the benefits of both, but I'm leaning more towards you go in with a chunk, and then I've seen people who a lot of traders like the retire on cover calls and dividends. A lot of them do is they take the money, the profit that they've received from their active trading, and they put that into passive trading, and they buy high yield ETFs like YMAG and the sort. So you're kind of like dollar cost average in, and sometimes it's good to buy them before, like right after, like on the ex-dividend date when it's like when it drops in price, so you can pick it up on a cheaper price. So you're kind of keeping your cost basis close to the actual cost. So if you did want to get out, you're not too far out. You kind of average your way down. So you could sprinkle some passivity to it. So that's something that I'm thinking about, maybe increasing my position over there. Again, like, the whole point of this is to buy your time back. I'm sure all of us are sick and tired of taking our time and trading it for money and, for a job that we are, that we may or may not like. Let's face it, you're there to work for your boss. You're there to work for somebody else. You're selling your time. You're giving a lot of power to your employer if you're living paycheck to paycheck and in debt. But when you are not living paycheck to paycheck and not in debt, and you are actually bringing in a significant income from a different source, it gives you freedom. And even if you like your job and like what you do and you want to stay where you are, at least deep down, you know you're being your true authentic self and doing what you love on your terms. Because if you're not treated right, you have that gall to just move out and do it. Find something else to do, start your own business or whatnot. If you are entrepreneurial, it could give you time to start your own. It can give you the courage to start your own business and start your own life. So, and again, you want to buy your time back. So you want to take the money, make your money, make money, and use that money to buy your time back. If there's something eventually you want to outsource instead of doing yourself, you can get somebody to wash your own car, to do your own taxes, to clean your house, to do shopping for you. You can use your money to buy your time back. Because I'm sure most of us, they say when you make your decisions, you want to make your decisions based on the perspective of your deathbed when you're dying. And that's when that's the mindset. Like, you're not going to think when you're dying on your deathbed, I wish I went to work a little more. I wish I worked a few more hours overtime. I guarantee you're not going to think about that. You're going to think about, I wish I went on that vacation with the family. I wish I helped somebody. I wish I did something in the world to improve something or leave some kind of legacy, and so here you could live your authentic self. And this is a pathway, because there's also a saying I heard that, money can't buy happiness, but being poor can't buy you shit, pretty much. So at least you could buy something. This is the Working Investor over and out. Hope you guys enjoy. Be well, be safe. Have a wonderful weekend.